Video is about investment risk and return. First, let's look at the required rate of return. Okay, as investors are risk averse, any risky investment should offer an expected return that is more than what investor can earn on a risk-free investment. The return that investors expect to earn on a risky asset equal to the risk-free rate plus risk premium. Risk-free rate refers to the interest rate of an asset that is derived by assuming no uncertainty about the future cash flow, while the risk premium refers to the additional return that investors expect to receive for assuming risk. When we say about investment risk, we can determine the total risk in investment by taking the market-related risk plus the company-specific risk. Market-related risk is denoted by beta, and it is sometimes also called systematic risk or undiversifiable risk or even a market risk. Okay, so this market-related risk is a portion of the investment risk which is undiversifiable, which is, in other words, they will be remaining there even if a portfolio is well diversified. And example, this risk may arise from the forces like economic risk, recession, inflation, fluctuation in interest rate, or even the political event. Okay, and these risks affect nearly all investment. And another type of risk is company-specific risk, or this risk is denoted by the alpha. And sometimes company-specific risk is also known as diversifiable risk or unsystematic risk. Okay, and this risk is a result from the factors that affect a single firm or a handful of firms in the market. Example, incompetent staff, okay, a production breakdown, or failure of new product. Okay, however, this kind of risk can be diversified away. Okay, in finance, there's a model called capital asset pricing model, or CAPM, that explain the relationship between risk and return for all assets. Okay, according to CAPM, an investor's expected return and an asset's expected return, or what we call it as required rate of return, is equal to the risk-free rate plus a risk premium. And the risk premium for CAPM depends on the asset undiversifiable risk, which is denoted by the beta value. And return required by the investors should be related to the investment risk. So the required return establish a level of compensation compatible with the risk involved. Okay, and the risk is shown by the beta value. So after investors have calculated the required return, okay, you can actually compare the required rate of return with the estimated return. If the required rate of return is more than the estimated return, you will say that the stock is overvalued. Or in contrast, if the required rate of return of a stock is less than the estimated return, you will say that the stock is undervalued. Or when you get that, when you found that the expected return or the estimated return is equal to the required rate of return, you will say that the stock is fairly valued. Okay, we can also explain this CAPM in terms of a graph. Okay, this graph shows that SML line. SML refer to the securities market line. Okay, this securities market line is a graphical depiction of the capital asset pricing model, where it explain that explain about the relationship between a return and a risk, and the risk is shown by the beta value. Okay, after you have already calculated the required rate of return, you can then you can form the SML line. Okay, and if you found that the required rate of return is higher than the your estimated return, you will say that the stock is overvalued. And from your computation, you found that the required rate of return is lower than the estimated return, you will say that the stock is undervalued. Or else, if the required rate of return is equal to the estimated return, you will say that the stock is fairly valued.